Hey guys, Zix here. Today I'm going to talk about leverage and how much you should use. But before we do that, stay tuned throughout the video. At some point in the video, I'm going to flash on the screen a promo code for our Discord server. 1 free week of premium. First 5 users to use that code will get 1 free week of premium. So stay tuned for that. Anywho, how much leverage should I use? This is a question that we get a lot on our Discord server, especially since we have the premium in our Discord server that straight up tells people how much leverage to use. And quite frankly, the bot was created, the algorithm was created to go ahead and do that. But it just says 20x every time, and a lot of people are like, why? What's the significance of that number? And I'm gonna be straight with you guys. The reality of leverage is it doesn't matter. It really doesn't matter, and I'm going to show you why later. But first, what is leverage, right? Some of you may have come here, and by the way, I'll put a timestamp if you want to skip this part of the video in the description below. What is leverage? Leverage was created as a trap. Now, if you do Google, if you do your little Google stuff online, that you're not going to see that. This is my own personal opinion. Because with leverage for Forex and trading and whatnot, it's not so much a trap. However, when you're talking about crypto exchanges and how they've adopted how leverage is used, it's straight up a trap to fool ignorant traders into thinking they're going to make a lot of money when in reality they're going to end up losing out. So when you're talking about leverage in Forex, which is, foreign exchange markets, this goes back a very long time. This is not a new concept. Basically, you have to have money stored away in your brokerage account to be used as leverage. But what ends up happening is, let's say you want to buy, I don't know, $100,000 worth of euro to the USD. But you only have 1,000. You only have $1,000 to trade. What the broker's going to do is he's going to say, okay, how much you got in storage to determine how much losses you can suffer. So what you're going to end up doing is you're going to say, I want to do 100x, right? 10x. $1,000 at 10x would be 100,000. So you go ahead and you make that trade. You buy $100,000 worth of USD or euro to USD. You only actually spend 1,000, and let's say the price goes up, and it goes up 10%. You just made yourself a lot of money, right? You just made yourself $10,000. So you 10x your entire bet. Well, let's say it goes down. Well, you had to put something on the table to risk. And when it comes to Forex, this is how it works. So let's say you wanted to risk $800. So if the price drops enough to where you're $800 in the red, you're instantly out of the trade. You not only lose that $1,000 that you leveraged, but also the $800 sitting there in your account. And so you're screwed. You're screwed, my friend. Crypto exchanges do it a little bit differently, actually quite a bit differently. Instead, they have a different kind of liquidation to where you're not risking any money outside of the trade. However, if it goes to a certain point, you just simply lose the entire trade. The higher the leverage you do, the closer to liquidation you will be. And this, my friends, is why it's a trap. Now, a lot of people will see this chart right here, and they will think, hey, this looks like it's going down, right? I'm going to draw a trend line like so. And yeah, look at this, guys. Oh my gosh. We are at the top of this. I should short this right now, right? I should short this right now. This looks like it's going down. But if you know anything about swing structure, you can see that this supply zone got taken out here. And if you don't know what I'm talking about, check my market structure video as well on the channel. The most likely thing to happen is this is going to come over this price, in my opinion. Now, it could still go down here, but we broke this supply zone, which means it's probably going to be going after a higher supply zone. The next higher supply zone is right here, and we just missed it. So my beliefs is that this is going to continue up into this 1 hour supply zone here before possibly continuing down, maybe even make a equal high on this or even wick above it. And so people looking at this trend line thinking, hey, I should short here, they're gonna lose, right? Assuming that's what happens. Of course, you never know. You can't 100% predict what's going to happen. However, so they see this, they see, oh my God, this is a perfect trade. I'm going to short here, 100x leverage, and one little itty bitty price movement up. They're shaken out. They're liquidated. They lose their position. They get pissed off. They throw their phone at their computer and they move along. So that, my friends, is why I call leverage a trap. You don't need to use leverage. I mean, there's situations where you do, and we're going to get into that. But the biggest problem that leverage traders do is they don't follow proper risk management. And I know that a lot of you have seen risk management videos online, so don't click away, okay? I'll try to make this as quick and painless as possible. This is such a super important feature about trading that people just completely don't think about. But you're going to hear this a lot, right? Don't risk more than 1%. What does that mean? That doesn't mean your position is 1%. That means what you're willing to lose is 1%. And 1% of what? Your entire capital. So if you're, and I will say this may sound odd, but I believe the average crypto trader with futures, maybe not spot, but the average crypto trader starts with a capital or a port for perps at about $100. That is may sound like very little to a lot of you guys, but that is what the average trader starts with, as crazy as that is. Now let's say you have 3 losing trades in a row. If you are only risking 1% to get back to your starting capital after 3 losing trades in a row is only 3.06%. That sounds logical, right? That makes perfect sense, right? Well, what happens if you're risking 2? Oops. What is that? Why did it do that? What happens if you're risking 2%? Okay? After 3 losing trades, you need 1 winning trade of 6.25% to make it back. Again, 2 times 3 is 6. Doesn't not, it computes, right? It makes perfect sense. But 6% is not exactly an easy number to get. Now, you can get 6% of your position in one trade very easily. But 6% of your entire port in one trade, that is not an easy thing to do. And let's say we up it. A lot of traders say 3%. Don't risk more than 3% per trade. We're getting close to needing one trade worth 10% just to make it back to where you were in the beginning. Now, I will say the average trader risks 20%. I know that sounds crazy, right? Crazy, Zix! The average trader risks 20% per trade. Now, if you're going to risk 20% per trade, which in my mind is crazy, and I will say I actually used to be like this back in the day when I first got started. After 3 trades, it takes nearly a double your entire port in one trade to get back. So the trap that traders fall in is they do risk 20%. They do have 3 losses in a row because they don't know what they're doing. And then what ends up happening is on that last trade, they don't risk 20% on the last trade. They risk 100%. And they end up with an account balance of 0. And oftentimes a trap that people will fall in, oh my God, I'm so far behind. What I need to do is risk it all at 100x leverage and go for broke. And that's what happens. They go broke. So now I want to give you a little rundown of what it takes to actually make money in this market. And so hold on, be right back. I got to go to a different page. Okay, we're back. So let's say you have a success rate of 75%. Now that's a very high success rate, but we're looking at winning, right? I would say the average winning trader makes about a 55% success rate. But if you're using our Discord server's premium signals, you're going to be closer to 75, 80% success rate. So let's just say you're using our signals. You're not doing your own trading. Let's say you start with a port of about $100. And this is saying 8 trades per month. Okay, this is the numbers that I'm going with for 8 trades per month. In month 1, you're only making $17. Okay, I know. It doesn't sound like a lot. We've got 3 winning trades, as you can see, and then 1 losing trade where we go down 1%. And at that point, it was 109.27, so 1% got us to 108.18. Right? Now, let's say that continue. Oh, and by the way, if you're risking more than 1%, these gains are less. Because remember what I said up at the top here, at the top of this spreadsheet. If you're risking too much, the losses hurt more than the wins. The losses hurt more than the wins. That doesn't make a lot of sense, but I'm hoping that I proved that to you up above. If you're risking 20%, yeah, those initial 3 wins are going to feel great. However, that 1 loss is going to erase it completely. So you have to keep that in mind. And any big time you hit a big loss like that, it takes so much more to come back. And again, what you end up doing is risking too much. So after the first month, you're only at $117. I know. Doesn't sound great. Month 2 now, we're at $138. And then, again, these numbers don't sound all that great. But we're only starting with a portfolio of $100. You have to start with something, right? And of course, this all changes too if you have a bigger port. If you have a port of 1,000, those numbers start to look a lot better, right? After the first month, we're at $1,170. But we're not doing that. I'm thinking my average viewer is probably around $100. You could do this math too. It's really simple spreadsheet math. So then, what we're gonna move this along. After a year of doing this, we're up 665%. Now, I'm not saying it's easy to maintain 75% of your trades, but I am saying in crypto, you're likely to be making more than 8 trades per month, right? Almost certainly, you're making 8 trades per month, and 10 to 20% profit per month is not unreachable. 10% is the industry standard for a successful trader. 10 to 20 is not impossible. So let's say we do that, and we do that consistently for 3 years. You've turned $100 into $39,000 after just 3 years, risking 1%, my friends, and only making 8 trades. Assuming you have a success rate of 75%. You've just made yourself $38,900 in 3 years. Now, if you're going to look back honestly at your own crypto trading career, be honest with yourselves. After 3 months of trading, were you up $60 on a $100 port? You tell me. Were you? I'm going to say 90% of traders are not. And the reason why is because they are over leveraging and they are liquidating and they are allowing themselves to get screwed. So, where are we at here? How much leverage should I use? We're past the risk management. So how much leverage should I use? Well, let's again, we're going to talk about Bitcoin here. Now, sometimes on some exchanges there are minimum entries. I believe KuCoin is 0.01. So, this is a little different, but we're going to just limit it to 0.01. Some people only have a port of like $20, right? And they're starting from nothing. So they really have no choice but to do leverage, because if you want to trade Bitcoin and there's a minimum entry, you're kind of screwed. So let's say right now, Bitcoin price is not quite 22. It's a little bit more than that, but I wanted round numbers to make it a little bit easier to look at. So let's say the Bitcoin price is $22,000 and the minimum entry on your exchange is 0.01. And that is a minimum entry on some exchanges. Others it's 0.001, but on some it is 0.01. That would mean with no leverage, you would need at least $220 just to get into any position whatsoever. Now, we're not talking about fees here. Different exchanges have different fees. I'm not calculating that in here. But the fees don't really matter, to be totally honest. Because, again, like I said in the beginning of this video, leverage doesn't really totally matter unless you've got a small port. Your people trading with $100,000, they don't really use leverage because there's no reason to. It makes no sense. Let's say you do 10x leverage, right? That means your actual amount of money that you're putting into the trade is $22. If you're risking $22 and you're just going to let it liquidate, you're actually risking 22%. So this is what I was saying, when the average trader risks around 20%, this is where I get that number from, because the average trader uses 10x leverage. And that's also the default. When you go to turn leverage on a lot of exchanges, the default is, in fact, 10x. So what ends up happening is they don't have a stop loss. They just let it kind of roll. And they, if they lose enough, they let it go into liquidation, and then they're risking on an entry at 0.01, they're risking 22%. And most of them get hit. They lose that 22% of their port. Now their port's only worth $78. And then they go ahead and they do it again and they lose it again. Or even worse, they add to the position and then they ride, right? They let it ride. And that is just the absolute worst thing you can possibly do on any trade. Do not add to the position. I used to do it, and I would get really high success rate because I had a lot of money that I could just throw at trades to just ride until forever. But that's not something that the average trader can do. So I don't recommend it at all. Now, if you become an experienced trader, you want to do that, that's on you. But most of my people are not experienced traders here. Most of you guys are still learning, and that's why you're on my channel, because you want to learn. So you end up going ahead and doing that. So what is this here? Stop position 10, 21.9. Stop position 20, 21.9. Now, if we're only risking 1%, regardless of the leverage, the stop is still 21.900. If we're only risking 1% on a position of 0.01, obviously if the entry is above 0.01, this stop position would change. But the leverage does not affect where your stop should be. If you're only risking 1% and obviously we're longing here because this is where the stop is. If you're only risking 1% and you're longing this trade, your stop needs to be at $21,900 regardless of the leverage. It could be, your leverage could be 100x, and it doesn't matter. Your stop would need to be here. However, at 100x leverage, your liquidation is going to be before your 1% risk stop. So you're actually risking 2.2%. At this, with all these numbers here, you're risking 2.2% because liquidation is your stop. And that is a big thing that people don't let click in their head when they do these super high leverage trades. So they'll do these super high leverage trades, but they're not putting down $2 margin. They're putting down $20 margin. And once again, here we are again, $20 at 100x leverage on what's going on here. That's 20% risk because you're risking the entire trade because your liquidation is so close that you're going to get screwed. And when your liquidation is closer than 21,900, the liquidation will probably be 21,930. I mean, it depends on the exchange. Different exchanges have different liquidation percentages. KuCoin at 100x leverage on Bitcoin is going to be under 1%. So you're probably going to be 21,930, 21,950, something like that. Average New York Stock Exchange volatility is going to liquidate you. Unless you're super lucky and you catch a big green candle, or you're shorting and you catch a big red candle, most of the time on 100x leverage, you are going to get shaken out, especially on some of your exchanges that don't have quite the liquidity like Binance. So they have tighter liquidation levels, like KuCoin, for example, Bitmart, exchanges like that. Some of your bigger exchanges, FTX, Binance, or whatever, their levels are going to be they're going to be past that 1%. So you could still do your risk management, but typically in a situation like this, if you're going to go super high leverage, you're going to get screwed. So the short end of this story, right? How much leverage should I use? It depends on your port, my friends. It also depends on what you're trading. If you're trading Shiba, you know, that has 0.00000 whatever the hell it is, whatever the hell crap it is now, it doesn't matter. You don't need to use leverage. There's no reason to. As long as you're using a stop, it doesn't matter. Look at this. This stop position for Bitcoin at 1% risk is 21,900. Regardless, you could have a stop position for no leverage. It's still going to be 21,900. The only difference is the margin is going to be more. But when you're talking about a coin like Shiba Inu, I mean, guys, it doesn't matter. It really doesn't matter. So don't worry about how much leverage you're using. Even when you're using our signals, just you do proper risk management, and everything else kind of just fills in the gaps. But don't do 100x. Just don't do it, all right? You're going to get liquidated. Now, unless you're doing 100x and you're okay doing a trade of $1, and you're okay if liquidation is your stop loss and you're okay with that, that's fine. Go ahead, do yourself 100x leverage. But when you're talking about high leverage versus low leverage, you can put more money down and your stop doesn't have to be quite so tight based upon how quickly you're going to get liquidated. So I hope that this was helpful. I hope that this made any sense whatsoever. When I thought about making this video a few weeks ago, this is actually like the 20th try to make it, because I had a lot to say on this subject and I couldn't figure out how to put it out there. I hope that this made sense. If it didn't, leave a comment in the description below. Remember, our Discord server also linked in the description below. We have very smart peoples there that are very happy to help. And of course, we have our premium side where you can get a little bit more one-on-one help. And of course, we have the signals. So that is it for this episode, this educational video. Thank you so very much for watching. And as always, take it easy.